The tech stock correction of early 2025 could have been attributed to China's DeepSeek AI platform. But now, in early April, it's starting to become obvious the main driver killing positive sentiment are the tariffs. Even I was speculating just over a week ago that this is probably only a minor correction, don't worry about it. I'm not so sure I was right there. My guest today suggests it could get much, much worse before becoming much, much better. He also hints at gold, currently at $3,000 per ounce, hitting $20,000 per ounce. Expert gold analyst Gary Savage from Smart Money Tracker joins me on this one. I hope you get a lot of value out of this episode. Obviously, none of it is financial advice, but there's some interesting things going on that you may just want to prepare yourself for. If you like this one, please give us a thumbs up, subscribe on the way through. Let's get started. Welcome to the show today, everybody. Today, global uncertainty amid recent tariff announcements have sent global stocks tumbling, with the Dow Jones falling almost 4%, NASDAQ making the worst single-day losses since 2020. Joining me to discuss is expert gold analyst Gary Savage. How are you, Gary?
I'm doing good, Darcy. Thanks for having me on.
Cool. How do the price patterns, the macro geopolitical events, cycles, and sentiment all play together to determine the gold price right now?
So the macro is what's driving the secular long-term bull market in gold and silver, but sentiment is what causes these intermediate degree profit-taking events and these intermediate rallies. So as we discussed before we started this, there's something going on in the stock market that I think is going to probably cause everything to take some kind of a semi-crash or mini crash here pretty soon.
What are some of the reasons why the price of gold is staying relatively strong while everything else is getting hammered right now in the share market?
Partly it's just fundamentals, but the major driver is sentiment. We've broken out of that 13-year cup and handle pattern. So that was the rule is the bigger the base, the higher in space. And that was 13-year basing pattern. So it's going to go a long ways. Probably my best guess is we're probably going to get to 10,000 before this tops. Now that's going to be anywhere from 2 to 4 years away. And we're going to have some scary intermediate corrections along the way. And I think we're setting up for one here any time now. Sentiment is driving it higher, mostly from that breakout, but also people are viewing it as a safe haven. So it'll probably be the last to roll over and drop, but I think the selling pressure is going to infect the metals here pretty soon as well.
Okay. And I know that the macro conditions, that's longer term piece maybe, and maybe that they kind of all work together to create these short-term catalyst events. But do you have any view around what might be going on, like with Scott Bessent recently confirmed as the U.S. Treasury Secretary of State Treasury Secretary, and just the rumors around monetizing gold reserves? Do you have any comment on any of that you'd like to share?
It's just the typical stuff we see at every intermediate top. When price has gone up for 3 months and it's gone up a lot, people start imagining all kinds of reasons for why it's going up and why it can never go back down. And that's all this is. They're not going to, nobody is ever going to go back to a gold standard. It's just not going to happen. And the gold standard didn't prevent countries from debasing the currency anyway. So just take it for what it's worth. It's just the kind of talk that you hear when you're getting close to an intermediate top and people have convinced themselves that there's some, magical fundamental reason it's different this time and it's never going to correct. When you start to hear that kind of language, that's when you need to start dancing close to the door, because the last chair is about to be pulled away.
Okay. You're no Peter Schiff, are you, Gary?
Well, I'm just realistic. I understand how markets work. They have big rallies, and then they have profit-taking events, and then eventually when price has gone down far enough and people are bearish again, then the fundamentals will put the fundamentals don't prevent a market from correcting. Sentiment is what causes a market to correct, but the fundamentals are what cause the market to bottom and then go back up again. So when people say, "Oh, the fundamentals are too strong," and that's why the market can never go down. That's nonsense. That's not what drives the market in the short and medium term. It's sentiment. And at some point, when a rally has lasted long enough and gone far enough, sentiment is so bullish that the last buyer has FOMO'd in, and now there's just no more buyers anymore. And then price will get stretched a long ways above the moving average. And then professional traders that have been in the market for a long time know what they're doing. They get nervous when price gets stretched really far above the mean. And we can look at the price of gold in the stock chart, and you'll kind of see what I'm talking about. They get nervous and they want to start taking profits. And as they do, and as the price starts to go down, then stops start to get hit, and that kind of exacerbates the selling. And then you get a multi-week or multi-month intermediate degree decline. And then at some point, fundamentals take over again, and you get another rally. It makes another higher high.
Right. So these narratives that are flying out over there, and you get a lot of experts who will gravitate towards one narrative versus another. A lot of that for the style of trading that you do is absolutely just noise, isn't it? Because you really are just looking at the patterns and the wheels within wheels that you see, and therefore everything else is really just a distraction, right? Like, I think that's quite a surprising probably framework for a lot of people who might think in narratives primarily when they invest. But for you, like that, like do you use that exclusively, just like a technical perspective first?
It's
Underlying
a
sentiment.
sentiment tell. So when I start to see all these kind of stories that uh, Asia's buying gold, that was the big thing in, when was it?
Yeah.
October or whatever it was, when we had our last intermediate top. Asia's buying. That's why price of gold can't go down. Well, it did go down because we ran out of buyers. And so it's a sentiment tell for me when I start to see these kind of narratives coming out that such and such a reason, and it's different this time, and that means it can't correct. I start to get nervous. And then on the other end, when I see people's, metals are crap, and miners are, they're just a waste of time and money. I'll never buy another miner again. Sentiment tell. It's telling you that we're about to run out of sellers, and the fundamentals are going to take over, and we're going to turn and go back up, and the fundamentals will take us back up, and we'll make higher highs, because that's what bull markets do. They make higher highs.
Yeah. Hey everyone, quick interruption. Investing for new wealth in the new world is a little bit more complicated than just doing what our parents used to do. We need to be a little bit smart to understand the environment, see it for what it is right now, and then allocate according to what will be successful in the future, not the past. If you want to work with me to discover what the ultimate portfolio looks like for you, then get in touch. Link is in the show notes. Let's get back to the show. Let's talk about the charts then. So considering the charts, broadly speaking, what are some of the patterns that you're seeing right now?
All right. So this is the weekly chart of gold, and this is kind of what I'm talking about. This is the 200-week moving average right here. And you can see that gold is stretched almost obscenely far above that 200-week moving average. Professional traders understand that all markets regress to the mean. So when price rallies for, this is I think we're 20 weeks into this intermediate rally. So a typical retail trader, he just becomes more and more bullish. The longer this continues up, the more bullish they become, and they convince themselves that it's different this time, and that there's no way that gold can correct because of such and such fundamental reason. A professional trader, on the other hand, the farther this stretches away from the mean, the more cautious they become, because they know that all markets will eventually regress to the mean. Now, the one time that this doesn't happen is when you get into the final parabolic, quote unquote, bubble phase of a bull market. So we're in the we're only a couple of years into this 8-year cycle. I doubt that we're going to get a final bubble blow off top until at least 4 years have gone by, maybe 5, maybe even 6.
Wow.
So I think it's too early for that. And if it's too early for that, then we've got to have corrections along the way to keep sentiment kind of tamped down a little bit and keep this running from 2011, all the way over to here. And then we get this long handle, get the 8-year cycle low. And now we get the breakout. And this breakout has been extremely powerful. Again, the rule is The bigger the base, the higher in space. And this is a huge basing structure. That's why I say we're probably going to 10,000 before this is done. But 20 weeks into an intermediate cycle, stretched this far above that 200-week moving average, we're getting to the point where we're going to need an intermediate correction, and you don't want to get caught when that happens. So you either need to have a tight stop, or you just need to be happy with your profits right now and get on the sidelines and wait for that intermediate correction, and then be prepared to buy when you see all the negative comments start again. Oh, the bull market's over in gold, and it's done, and I'm selling all my gold, and so that'll be time to buy, because it's not over yet.
When you say the bigger the base, the higher in space. So if we look at a pattern of a cup and then a handle, like a teacup type thing, for those that are listening and not watching, if that teacup from edge to edge, are we talking about the width of that base or the depth of that base that determines how much in space the price goes?
Yeah, it's a time factor. So the top was 2011, and we didn't, we kind of broke out, but just late in the 8-year cycle. So breakouts that occur late in the cycle don't generally produce sustained moves. So that's what happened here. It was just too late in the 8-year cycle for this to give us a sustained move. And so we started this handle formation. We get our 8-year cycle low, and then we get the real breakout right here. And like I said, we're still very early in a brand new 8-year cycle. So we've got at least 2 more years to go. It could be as many as 4 or even 5 more years to go.
Wow. So 2 to 5 years of a very volatile yet interesting time, where we're basically making new all-time highs, followed by really harsh pullbacks, followed by maybe a blow off top right at the very end. Is that kind of what you see over a 2 to 5 year period?
Correct. And it's going to get more volatile as the bull market matures. So, this phase here has been pretty easy to trade from the long side. I mean, we've had some sideways consolidations that were frustrating. But all in all, this has been a very, very powerful, very trendy move. But as we get deeper into this 4-year cycle, it's going to get a lot more volatile and a lot harder to trade. And I think that's where you want to have physical gold and silver. You'll be able to hang on to those positions through some really wild swings that I think are probably in our future.
Got it. Yeah, holding the physical, you're less likely to dump it in a panic because you got to go to the safe and, sell it on the market and all that sort of stuff. So yeah. Okay. Now going back just to I think when we caught up last year, that would have been a year ago, price of gold was actually 33 and a third, less than what it is right now. So it was 2/3 of the price of it is right now. And I remember you saying that, you were probably a little bit more tentative, but you could see the pattern like we're looking at today, but we were just 1 year ago. And correct me if I'm wrong, but that was the beginning of the breakout, right?
It was. And I noted at the time when this happened, the quote unquote cartel, bullion banks, whatever, the entities that try to keep the metals suppressed, they tried multiple times right here to drive gold back below 2,000. And then when they failed and we started to get this breakout, I said at the time that the manipulation of the gold market, not necessarily silver and miners, but the gold market had broken. And you can see what happened when that suppression broke. This is what happened. We get this massive short squeeze rally that has sent gold 1,200 points higher already.
Can you just break down for our audience the mechanics of what's going on with this short squeeze? Just conscious that some listeners of yours might not fully appreciate the price suppression that may be occurring with big banks trying to keep the price below a certain point, and when it breaks. Can you just cover off just how that works?
So I'm sure a lot of people have noticed this. You'll get these big contract dumps in the middle of the night. That's never going to happen naturally. There's just no volume in the middle of the night. So nobody is going to sell. Well, it's illegal to trade more than 3,000 contracts anyway, but there'll be nights, in the middle of the night where you'll see 10,000 or 20,000 contracts dumped. that's not natural selling. That's a suppression of the market. They're trying to get the price to drop because there's no buyers in the middle of the night. So they're trying to drop the price, and then when the market opens, you get people that are panicked, and then they add on to that selling, and that keeps the price suppressed. And they pretty much more or less had their way with gold and silver, and they didn't stop the bull market, but I would say they delayed it uh, by many years with this price suppressions. But then once it broke here in last year in the spring, um,
Mm.
all of those shorts got caught, and they had to cover into rising prices, and that's why you get this almost vertical move in gold.
Yeah, and you'd think they learn a lesson, right?
You'd think they're going to make the same mistake with silver.
Yeah. Well, where is silver at now in this story? Is it going to play out in the same sort of way, or is it going to play out differently, you think?
Well, I was let me go to the silver chart. I was kind of hoping that once we silver broke out above this line in the sand here at about
Yeah.
33 bucks. You can see it's just, every time I get there, they hit it, hit it, hit it, finally get above it here. But again, it's late in the cycle. So no sustained move, back down, hit it again, again. Like six times they prevented it from getting above 33. I guess that was kind of the warning sign. I was looking for $40 on this intermediate rally, but I guess after 6 weeks of blocking it at 33, I should have realized that they were just eating up too much time of the intermediate cycle, keeping it locked below 33. So that was decreasing the chances of it actually making it to 40. And then of course, we get up here this double top and they're hitting it again. And then today, Thursday,
Mhm.
everything's starting to sell off, including silver. So I think we missed our chance. I was really hoping that a breakout above 30 would be the end of the suppression in silver, but I think I'm going to end up be wrong on that. They managed to keep it locked below 33 for too many weeks, and we just ran out of time. So it's going to have to be the next intermediate cycle where we break the suppression in silver, I think.
And how long do you think it'll take before we get there?
Well, let me go to the daily chart. Um, Very often, a first daily cycle will recover all of the losses from an intermediate degree decline. Now, I'm not sure that's going to happen now because, as we said, we've got what I think is a 4-year cycle low in progress in the stock market. And that selling pressure is going to probably crash everything here sometime in May or in April. I'm sorry. So, silver is a thin market. Generally speaking, I would say that um, silver is not going to go below the previous intermediate cycle low. But if the stock market is in a 4-year cycle low and the selling pressure, the margin calls um, just crash everything, which is what almost always happens during a 4-year cycle low, silver
Mm.
could, and it could go back down and go below this pivot. But I think that will be your buying opportunity. It'll be incredibly hard to pull the trigger at the bottom. But I think the rally out of that's going to be a huge rally. And I think at that point, we will finally break the suppression of the silver market. And then we'll get our next leg up in gold, which
Right.
I want to say gold is the odds are pretty high that we put in a top at 3,200. That was kind of my target for this intermediate cycle. Um,
Right.
the next rally, I think, could get us to 3,500.
Okay. And do you want to just cover off what the motive is behind the price suppression? Is the motivation really to stop the spread or stop entrenched inflation, or is there something else going on, something more to the
I
story?
I think that's the one of the main. Well, basically it's a money cow for the banks. They can control price in both directions. But I think it's also beneficial for governments to try and control the price of gold. If they can keep gold in check, generally the rest of the commodity market isn't going crazy to the upside. So, I mean, you could try to suppress every commodity market and keep the inflation in the stock market where it's considered basically good inflation. When it gets into the commodity markets, it's quote unquote bad inflation.
Mm.
It's impossible, of course, to control every commodity market, but it is obviously it's possible to keep the gold market suppressed. And if you can keep the gold market suppressed, most of the other markets don't get too terribly out of control. So I think that's been the main motivation, maybe the reason why nobody really tries to enforce the rules in the metals market. They're more than happy to keep the metals price suppressed as much as possible. And like I said, it's a cash cow for the banks that are doing it. They know they can take the price down and they can make money on the shorts, and then when they cover the shorts, they can make money on the long side. So but then if they get caught with those shorts, they get caught in a huge short squeeze and they lose billions of dollars. No telling how many billions they lost on that gold move.
Right. Yeah, right. And when it happens with silver, it could be even more explosive, right? So I think before you were saying the price of gold ultimately could kind of reach maybe even up to what, $10,000 per ounce from where it's sitting right now, over 3,000.
That's not even that much. It's only a 200%,
Yeah.
a
Yeah.
little over, I guess. But I mean, that's fairly mild.
Yeah.
Silver, I think, well, I'm on record. I'm going to say that $100 silver is going to be a piece of cake. Doesn't mean it's going to be an easy ride to get there, but I think it'll get there. I said the same thing about the NASDAQ back when it was, not even at 5,000. I said 10,000 is going to be a piece of cake. 20,000 is likely. No, we hit 20,000. Wasn't an easy ride to get there, but we got there. So I think we'll get to 100. And realistically, I think we'll probably get to 200. We might even get to 500 during the last 8 weeks of the bull market when things are going straight up.
These are significant numbers when you consider we're at 33 right now. So this is like, that's quite significant. And just going back a bit there before, you were kind of hinting at maybe even more than 10,000 per ounce for gold.
Could be. It's not unusual during a final bubble phase for the price to double in, well, the price of silver could double literally in 8 weeks. Gold could easily double in 6 months. So let's say we take 3 years to get to, I don't know, 7,000, and then we double in the last year in that final parabolic move where every Tom, Dick, and Jane is buying gold and silver. Well, that brings you to 14, maybe even as much as 20,000. So I think 10,000 is a reasonable target, and we might go above that.
Wow. Crazy. So like I'm looking, or I looked before jumping on this call with you at just where the NASDAQ was and where the Dow was, and both down significantly. Looking at gold, and yeah, like it's been a bit of a blip, but really it's holding its own, right? And I'm kind of thinking, right, well, if we're not just in correction territory with equities, we're actually in more crash territory, or that's where it's going. At what stage does gold and silver get hit just by the overall negative sentiment that's playing out in the market generally?
So let me put the chart back up, and I'll show you what happened in 2020 because I think it's going to be very similar again this time.
Sure.
So this is the crash of 2020 when the stock market COVID crash. That was a 4-year cycle low in the stock market, and what happens during one of those? Eventually, the selling pressure becomes so great, and there's so many margin calls hitting that everything gets sold. So this is gold, and you can see the crash started. I think it was on the. I want to say the top came in on maybe 20 or 219, so somewhere in here for the stock market, and gold resisted, and then finally in those final couple weeks of the crash, the bottom just fell out in gold, and then the miners even more extreme. So here's the miners. So you get this breakout, and it's like, the miners are ignoring the market. Like today, people are, the miners are holding up well. Yeah, but I think probably this is going to happen here. Just when you get into that last 2 weeks of the stock market crash, it just takes everything down with it. And that's not really due until maybe the end, maybe the latter part of April. So I think we got a ways to go, and I'll put the S&P up here. So this is this was our last 4-year cycle low. I kind of thought maybe this was a 4-year cycle low, but it came really early. So I was always suspicious that maybe that wasn't it. A 4-year cycle low will break this 4-year cycle uptrend line. So I'm gonna assume that this is not the 4-year cycle low because it came, it wasn't even 3 years into the cycle yet. So that means that this is our trend line from this bottom through this pivot. We've got to break that trend line before the 4-year cycle low is done. And that means we got a long ways to go yet. And the selling pressure is really just getting started. When we really start to get 3 and 4 and 500 point down days in the S&P, everything is going to take a hit. So
Sure.
I would be very cautious about assuming that the metals are going to continue to hold up. I think the same thing is going to happen that happened in 2020. Eventually that selling pressure will infect it and they're going to take a hit along with it. Now, I will say it's going to be the buying opportunity maybe of the decade. So if
Wow.
you can, be patient, stay in cash, don't be in a big hurry to buy, and then when it looks like the world is ending, that's the point where you want to buy. That'll be the buy of the decade.
And the reason it'll be the buy of the decade is not just because this is a random commodity. This, in my view, this is money, and this is probably a safe haven play, and this is a flight to something that it will preserve wealth when it feels like everything else is falling, right? But would you go that far? Like, are you a bit of a sound money guy deep down inside, or is this really just an ingredient to trade with? How do you kind of look at the rebound and
I'm
the
gonna
story?
I'm gonna say it's gonna be a buy in everything, just like it was in 2020. Everything's gonna go up big. So you can buy stocks, you could buy gold and silver, you can buy energy. I think biggest potential is going to be in the metals, but I think when we get this bottom, you can buy anything. You can throw a
Right.
dart at the board and you're going to make big money, but
Yeah.
it's going to be really hard to pull the trigger because it's going to look like the world's ending. And if you're a little bit early, you could take a huge drawdown. I mean, literally, you could be 1 or 2 days early and take a 20% drawdown. It's hard to hang on through that. But if you understand what's happening, that these 4-year cycle lows are major buying opportunities and the drawdowns are brief and the recoveries are violent and quick, and in gold and silver, that will kick us. It may kick us off into a bubble phase in the stock market as well, but I think it'll kick off that final bubble phase in gold and silver as well.
Okay. All right. So I guess for those people that might be wondering, hey, we're at all-time highs right now. I hear what you're saying about the risks of a significant pullback in markets, but just generally, would you say that it's too late to get into gold? Like, if those that want to get in, should they kind of get ready but wait for this event? Should they do dollar cost average in? What would you say?
No, they need to wait right now. Remember that chart I showed you how far gold is stretched above the 200-week moving average? Now is not the time to buy. You don't buy 20 weeks into an intermediate rally. You want to buy on week 1 or 2 of a new intermediate rally. So we've got to have the intermediate correction before it's time to start buying. So you just
Sure.
need to be patient. You need to wait for the sell off to occur. When the weekly charts get oversold, that's your signal to start looking for a time to buy. Not right now. Right, it's too
Sure.
late. It has to move. You've had 20 weeks to get on this, and if you've been holding out, now's not the time to FOMO in. Now's you just gonna have to be patient. Probably the end of April, maybe beginning of May.
Okay. And we'd be looking at roughly 20-ish%. So gold price of what, 2,400 per ounce or even lower?
No, not that low. I think gold's probably going to go maybe 27, 2,800. Seems
Okay.
like a reasonable target. I look at the Fibonacci retracements. Generally speaking, I assume that a 38% Fibonacci retracement is minimum and a 50% is realistic, especially when prices stretch that far above the mean. So
Right.
whatever that comes out to, would be kind of my target zone.
Okay. And let's just fast forward now. Let's say that the market rebounds violently. Everything's going up. You're throwing darts, the dartboard. Everybody's a genius. Everything's winning. Gold reaches somewhere between 10 to 20,000 per ounce, or even more. Who knows? But then inevitably we reach a new reality, a new normal. It's hard to speculate this far out, I'm sure, especially with the wild card of inflation and what that could end up doing to the currency, the denominator. But what do you see the price of gold being after this like boom cycle, this bull run has fully completed?
Assuming we get a parabolic move, those always collapse. And generally speaking, depending on how big the bubble is, it's going to retrace 80 to 90% of the move. So if we go, let's say if we go to 10,000, I think you can count on it coming back to 2,000.
Wow. Okay. Like going back all the way back to where it was during that handle, right?
Yeah. And then it could take multiple years of churning back and forth and not really doing much of anything before the next bull market's ready to take off.
And that's where, I guess that's where gold gets its bad reputation from, right? Like that, I've heard people say it's a great asset to date, but you never want to marry it because it inevitably you're stuck with a lump of metal. No disrespect to all those spouses out there. You're stuck with this lump of metal that doesn't produce a yield for a very long period of time, right? So would you kind of at that stage just get out of trading gold and move on to other assets like oil or currencies or something like that?
Yeah, well, everything has its time in the sun. There are periods where gold, hard assets do really good, commodity bull markets. And then there are times where stocks do really good, a secular bull market in the stock market. So gold is probably in the last 2 to 3 years, maybe 4, of its long-term secular bull market. But once you get that phase where every Tom, Dick, and Jane is buying gold, then you've got to sell your gold, and you understand that there's going to be a multi-year bear market, and you have to look somewhere else to, and look for something that's really undervalued at the time. Maybe that'll be stocks. Maybe they will have had, a huge, bear market, secular bear market, and are seriously depressed, and nobody believes that stocks can ever go up again. And so that'll be the time to buy stocks.
Or just go outside and enjoy the outdoors, go mountain climbing, right, Gary? That's kind of what life's all about.
Buy some real estate or go rock climbing.
Yeah, maybe a bit of both. Maybe a bit of both. So we talked about this last time as well, and I think it's quite an interesting strategy which helps protect you from making emotional decisions. But if you were an everyday person, not an expert gold trader who's watching the charts all the time, but if you were an everyday person and you wanted to have a long-term allocation towards gold, but at the same time you wanted to engage in a little bit of trading around gold because of where we're at right now, how would you recommend people do that? Like through exchange traded funds, through the mining companies drawing this out of the earth, or just through holding the physical?
So my recommendation for my subscribers to my newsletter, 80% needs to be in physical gold and silver. That's probably where you're going to get your life-changing gains, because you'll hold through all of these intermediate corrections. You're not going to panic and sell at the bottom, because it's not easy to sell. You got to, especially if you got, 500 pounds of silver, it's not easy to cart that down to the bullion dealer and sell it. So you'll be able to hang on through all of the volatile swings. And as I said, it's going to get worse, not going to get better. You'll hold it all the way to the top, and then, hopefully you'll sell on the way up in that final bubble phase, not get caught when the crash comes. And then if you want to trade 20%, I'm okay with that. And that's kind of what we're doing. We try and catch these intermediate bottoms, trade them with some leverage, but the vast majority of our funds are just buy and hold in physical gold and silver. When we get an intermediate cycle low, we buy more.
Got it. And so in terms of how people can interact with you, obviously subscribing to the SMT Smart Money Tracker newsletter, is that right?
Yeah. Now I will say the SMT is going to be closed here pretty soon. I've actually closed the SMT to monthly subscriptions as of the beginning of this month. I still got the basically, I'm just looking for loyal subscribers that have been with me, that understand cycles, understand how markets work, aren't going to panic every time we have a down day. Those people, if they want to ride the rest of the bull market with me, then I'm asking them to just take out a yearly subscription, and we'll, however long this lasts, another 3 or 4 years, whatever. So I've closed it to monthly subscriptions. I do still have the link open if somebody wants to get in for a yearly subscription and stick with me for the rest of the bull. But by the end of this month, even that will be closed, and I won't accept any more new subscribers for the rest of the bull market.
And what you're doing really on that newsletter is you're performing some sort of analysis to explain where we're at and like giving buy and sell signals. Is that what's going on?
Yeah. So basically, we're trying to get in at as close as we can to intermediate bottom, and we're trying to get out at intermediate tops. We won't get them perfectly, but we usually get close enough to where we make some pretty good money. I think most of the people, we've ridden the first part of this bull market in gold, and there were some red flags popping up, so we've taken profits, and at this point, it's like I don't really care if gold and silver continues higher. My physical will catch that, but I'm not prepared to keep any leverage trades on right now. I think right now for your trading account, you just want to be in cash and let this whole thing play out, and then maybe in April it'll be time for another trade in the metals.
I like that paradigm or that allocation, right? 80% you're holding physical, 20% you're trading, but right now you're basically in cash waiting for a pullback before you get in. It makes a lot of sense. Okay.
Mm-hmm.
And you don't operate a fund or anything like that, do you, Gary? No. It's okay. So it's really just the newsletter. And so I'll put a link into the show notes so that if people want to jump on there, that's cool. But as we're coming for a landing, Bitcoin is one of those assets that I follow pretty closely as well, kind of almost in tandem to gold. And I wanted to know if you had any thoughts around this, because I heard you talking about a month ago, I think, on another podcast where the price of Bitcoin was over 100,000. And you were kind of hinting at, I'd be careful at this point. It's kind of due for a drawdown. And lo and behold, we're 20% off that number now. What are your general views, though, on Bitcoin? What do you see happening over there?
I suspect that the selling pressure will infect Bitcoin as well. So I don't think you should buy anything right now until the stock market finishes this. Like I said, I'm going to say I'm 75% convinced that we're in a 4-year cycle low, which means we have to break that trend line, which is still a long ways away. And so until we do that, or until I become convinced this is not a 4-year cycle low, I don't think you want to buy anything. And that includes Bitcoin, energy, maybe bonds. And I think the dollar is going to bottom here pretty quick. It's kind of what happened the last time too. The dollar went down initially as the 4-year cycle low in the stock market kind of started, but then the dollar bottomed and then rallied violently. And I think that's probably in the cards as well. I think the dollar is going to find a bottom here soon and probably rally pretty hard.
Yeah, that's a really good insight as to what we might expect. Obviously, nobody can see the future clearly, but I know since I've been following you, you seem to see it clearly compared to some of the other people. So let's see what happens. That's awesome. Well, maybe we'll catch up in a year and just check in again to see how things have gone. But thank you very much, Gary, for coming on the show and sharing your thoughts and predictions. Really appreciate that.
Thanks for having me on.